Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And this week is going to be a big one. Stocks exploded last week. Tech stocks in the Nasdaq jumping 7% with the bulls stampeding back, fueled by a temporary truce in the trade war. With the market charging towards new highs, it's time to open the vault and review some of our favorite stocks here on the channel. So I'm revealing the top 10 stocks in my $2.5 million portfolio, what I'm buying, why, and the price targets to watch. Stick around and I'll update you on the market outlook along with important news on shares of Airbnb and Palo Alto Networks. Let's get right into it though, because this week as part of our market update, I want to update you on 10 of the stocks we talk most about here on the channel, my 10 largest stock positions. So I'm opening up my E-Trade account to count up to the 10 stocks worth over $2.5 million. First though, 3 things need to be said here. First, I don't want you to think that you should only be holding individual stocks. I have my ETF portfolio in another account, and it's more than half of my total wealth in these broad-based ETFs. It's that core satellite strategy that I've talked about here on the channel, benefiting from the stress-free market returns in those ETFs, while I invest the other portion in my favorite individual stocks. I'll be updating my ETF portion soon, so make sure you're subscribed to the channel so you don't miss out on that one. Also though, while these 10 stocks are my favorite long-term holdings, I do have some covered call options sold against them, protecting my portfolio from another drop, but still keeping that upside potential. Options are my single best tool for fine-tuning my portfolio around some of those near-term market crashes like we just saw. If you want to see how I use options to boost returns while also limiting risk, look for the special $150 off coupon link in the description for an exclusive offer on our options investing course. Try it risk-free for 14 days and get started using options. And the third important point here before we count down to those biggest holdings is that you're going to see, even through that stock crash, and despite the fact that I believe we're going to see some more market weakness through the summer, I haven't sold out of any of these stocks. These are long-term buy and hold growth names, and in fact, I bought more in many of them through that April plunge. While I used some option strategies earlier in the year to limit my risk, I'm holding on to these, and you shouldn't be letting that near-term market fluctuations scare you out of some of your best long-term stocks. Let's start here with Zscaler, ticker ZS, one of the 3 stocks I hold in my favorite growth theme, cybersecurity, where I hold a total of $240,000 invested in 3 names. I own 300 shares of Zscaler for just over $73,000, and I'm up 41% since starting to add to the position. And that's another important point here, that in all of these, I continue to add to my positions over time. Whether it's on any big dips in the price or just investing regularly, you should continuously be adding to your favorite stocks. Investors spend hours trying to find that next hot stock, but usually the best to buy are already in your portfolio. Zscaler doesn't quite have that top growth, profitability, or valuation to make it stand out among the largest cybersecurity stocks, but it does have a 20% plus revenue growth and, in my opinion, one of the better platforms with its zero trust security. The company announced a closer relationship with industry leader CrowdStrike in September that, while we're still watching for that to move the needle on growth, I think it helps position the company for success. Shopify, ticker SOHP, is one of my favorite names in the e-commerce, with 900 shares worth over $98,000 and up 74% on my average cost, one of my best returning stocks. Shopify helps everyone from businesses to individuals sell on their own website with a pricing plan for every size, and what I love about this model is builds an amazing system for recurring revenue, locking in those customers in that platform and then collecting those fees every single month. Shopify has grown recurring revenue at a 29% annual pace for the last 5 years. And that e-commerce market is still less than 15% of global retail sales, so a lot of room to continue that growth into what Shopify estimates is an $849 billion market opportunity. The company got good news recently that shares would join the NASDAQ 100 index May 19th, adding it into those index funds in the portfolios that track the index. SoundHound AI, ticker SOUN, has come down off of last year's peak of $25 a share, but are still up 175% from the $4 share price that we started buying it at last February. I took profits on a lot of my position in December and January, but then started buying again during April's crash, building back to a 10,000 share position, now up 32% in less than a month. Folks, agentic AI is going to be the first wave of use cases, and SoundHound is the leader in agentic voice assistants, a market it estimates as large as $160 billion, but I think is even larger, and dwarfs the company's $85 million in revenue last year. Besides its use in cars across Europe, SoundHound is now expanding into drive-thru ordering, partnering with fast food chains so you can order from your car on the way, no more waiting. Revenue is expected to nearly double again this year to $160 million. I think next year's forecast for 25% growth is going to be revised upwards when we see some of the company's projects really build momentum. Shares aren't cheap here at a price of 28 times this year's expected sales, so market cap divided by that $160 million forecasted revenue. But I would still be slowly accumulating shares here so you get more exposure. Shares of health insurer Humana, ticker HUM, got slammed last week, first on weak earnings reported by United Health, then again when it was reported that the Department of Justice is investigating UNH for its Medicare billing practices. Now, Humana is my only loss in the top 10 here, with 500 shares down 11%, though there's still reason to hold on to this stock. These shares are down 45% from the high just last July on a wave of problems in the Medicare Advantage health insurance marketplace that has affected everyone from UNH to Humana, CVS, and Elevance. But against those problems, Medicare Advantage plans cover 54%, or 32 million of the 60 million Medicare-eligible Americans, and could be the government's best bet on reducing some of its $839 billion spent on Medicare every year, getting people off Medicare and into the cheaper Medicare Advantage plans. So this industry isn't going away, and there's reason to believe that Humana is better positioned to recover when that rebound happens. The Trump administration is already showing it to be more favorable than the last, increasing Advantage plan reimbursement rates at 5% this year, more than double the previously announced increase, and this industry will recover, so I'm holding on to those shares of Humana for that ride higher. CrowdStrike Holdings, ticker CRWD, is my largest cybersecurity investment, with 300 shares worth just over $131,000, and up 58% on the shares. CrowdStrike offers the best all-in-one defense with its Falcon platform for enterprise clients, bar none. And besides booking some of the best revenue growth and profitability in the industry, shares are not ridiculously expensive when you adjust them for growth. And here's Symbotic, ticker SYM, could be the sleeper stock of the group, up just 13% on my cost basis, and $154,000 investment on 5,600 shares. The stock jumped on its recent earnings, showing a narrower loss to just 4 cents per share versus a loss of 9 cents a share last year, and a 40% revenue growth to $550 million. The company develops, installs, and manages warehouse robotic systems, a market it estimates at $1 trillion. And now combine that with the reported $23 billion in backlog revenue, you can see how growth off of last year's just $1.8 billion in sales will continue to surge higher. We haven't heard yet much from the January agreement to buy Walmart's warehouse and delivery robotics business, but the company already has a 4-year partnership with the world's largest retailer. This is going to further cement that relationship. Symbotic says that January deal alone could increase the order revenue backlog another $5 billion. Nation, this stock is one of my favorites for undiscovered potential, with sales forecast to grow 20% plus this year to $2.2 billion. The stock trading for just 1.4 times on that price-to-sales basis. Extraordinarily cheap for that kind of growth. Next is one I know a lot of you were there with me because you commented on the returns. Shares of the trade desk, ticker TTD, up 70% in the past month, and my fourth largest holding at 2,500 shares, worth nearly $200,000. The stock had been suffering under a weak fourth quarter earnings reports, fears of competition, and worry that advertising budgets would crater this year. I looked at the stock and saw the leader in e-commerce advertising with a 10% share of the cross-device and connected TV space. It's an ad market of $135 billion and still just a fraction of the $900 billion global ad market, which TTD is primed to take advantage for more growth. So you see, just like with Shopify, I'm positioning here in the leaders within that ever-growing e-commerce market and have been rewarded. Shares jumped when the company reported first quarter earnings that showed 95% client retention, putting to rest those fears of competition, as well as revenue growth of 25% to $616 million, easily beating the $575 million Wall Street forecast. We're getting into my 3 largest positions here with SoFi Technologies, ticker SOFI, and my best return of the group, up 112% on 15,000 shares, along with holdings in other accounts here. I am a big believer in the digital bank story. SoFi has been the stock to watch, with platform members up 34% last year to 2.8 million, and the company accelerating its platform and service revenue 54% last year, with total sales growing at a 23% pace. But then with that return, since we started buying under $7 a share when everyone said we were crazy, with that 112% return also comes a stock that is just too expensive to add more right now. On that price-to-book valuation, which is how you want to value those bank stocks, the shares now trade at 2.3 times book value. That's more than 3 times the 0.75x valuation where we started buying the stock, and well above the 1.6 or maybe 1.7 times valuation where I would consider the stock fairly valued. So this is where I do have some covered calls against that stock, protecting my profits if the shares come down. I'd be willing to reconsider SoFi again if the shares came down to around $10 each, or if the book value came up enough that I could get it for around that 1.6 times price to book valuation. I still like the long-term growth story for the company, but looking at other bank stocks, you just can't justify a valuation where the stock is right now. The rest of the market just started seeing what I've been talking about on shares of Advanced Micro Devices, ticker AMD, up 40% since the April low and 20% just in the past month. I'm up just 10% on my cost basis for 2,500 shares, worth almost $300,000. But this one has been a long wait. AMD has been getting no love from analysts as Wall Street abandoned the semiconductor maker through the year, but I saw a company growing revenue by a solid 20% plus pace, and while it's obviously not the leader in chips, that market is growing so fast that AMD should be rising with the tide. In my research, I also found that AMD was taking advantage of delays along with super high prices for NVIDIA chips to grab more market share, stocking retailers with as much as 4 times the available inventory in graphics cards. All this was on a stock priced at just 6 times its sales, which is very cheap for a company growing that fast. And just recently, AMD proved it can compete and win deals with a $10 billion partnership with Humana of Saudi Arabia to build out its data center infrastructure. And the largest stock in my portfolio by far, Supermicrocomputer, ticker SMCI, of which I own 24,000 shares worth over $1 million, and up 35% since we started buying late last year on a gain of $280,000 on the position. Now this one is still very volatile, bouncing higher and lower, so I've been taking advantage of some of those big moves higher to sell some call options against it and de-risk when I can. Those of you out there in the nation know I try not to hold more than 10% of my money in any single stock, and SMCI right now is upwards of 14%, but the potential here is just too good to pass up. I argued last September that the short seller accusations were all bunk, and we bought shares all the way down to the low of $17 each for that $32 average cost. SMCI is the AI pure play stock with its server solutions booking 48% growth this year and 37% next to $30 billion in revenue. Now I dare you to find any other company growing sales at that pace and trading at just 1.3 times on a price to sales valuation. That is ridiculously low, and think about this one. On that forecasted $30 billion in next year's revenue, it would be just 0.89 times price to sales, when a fair value should be closer to 2 or 3 times sales. So this is a stock with much more upside remaining. On to some big news and the stocks I'm watching this week. Airbnb, ticker ABNB, dropped a big announcement last week that could break the stock out of its 4-year slump, down 6% from its IPO. The company announced the launch of its Airbnb Experiences app, a marketplace for services, and an attempt to create a consumer super app for travelers. A forecasted revenue and earnings growth this year and next of around 8% is good but not great. And for that kind of growth, shares are still a little pricey here at 7.8 times price to sales, but I would be watching this one, put an alert on around $125 a share where I might start buying. Any added growth from that new app could recharge sales and bring investors back fast. Palo Alto Networks, ticker PANW, isn't one of my larger positions, but I do own 200 shares, so we're going to be watching Tuesday when the company reports its earnings. Revenue growth has been slower at the largest cybersecurity company, though it's hard to beat on the profitability, the second highest of the group, and a much more reasonable valuation as well. This one has a history of big moves on its earnings, up in 7 of the last 11 reports, but also down hard on the remaining ones. I'd be watching for any pullback to buy more shares. I'm also watching Ralph Lauren, ticker RL, as it reports its earnings on Thursday and exemplifies what I think is going to play out for a lot of the retailers, and in doing so could dampen some of that investor mood for the broader market. Shares of the apparel retailer have clawed back nearly all of this year's drop, and while earnings are expected to jump this year to $12 a share on about 6% sales growth, investors could be in for a big disappointment on profitability that hits the forecast. As recently as 2022, the company sourced 97% of its products outside the United States, with 38% from China and Vietnam alone. That likely hasn't changed, and even the 10% tariff on Vietnam imports or the 30% tariffs on China during the pause are going to hit profits. Take this one with the fact that on the rebound, the stock is trading at 24 times on that price to earnings basis, the most expensive it's been for more than a year, and the odds are for a big disappointment in earnings. Updating our market outlook, the 20% rebound of the S&P 500 has taken it back into expensive territory, bouncing from the 10-year average PE ratio of 22 times in early April back to over 26 times earnings companies have reported over the last year. And folks, I gotta ask myself, while tariff rates have come down, do investors really think that all is rainbows and unicorns once again? The Consumer Price Index, that CPI report of inflation, showed that early effects of tariffs with a 0.2% pop in the month-to-month numbers. And Walmart warned Thursday that it's still going to be raising prices this month, with some prices up double digits. Consumer sentiment has already plunged to the second lowest reading on record as shoppers prepare themselves for those higher prices. So put all this together, and while I'm ecstatic that my portfolio is up more than $500,000 over the past month, I do think stocks are getting ahead of themselves. The summer is typically a weak time for the market anyway, and it's over the next few months that we're going to start to see those price increases and that economic activity probably slow some. The CME FedWatch tool shows the market now expecting no changes in interest rates until September, which means no help from the Fed or monetary policy to support the market. It's why while I'm keeping those positions in my favorite long-term stocks, I'm also taking some of those profits on other names and even covering some of my favorites with that covered call option strategy to reduce the risk through the summer. Get your $150 coupon to our Ultimate Options course with a link in the description below. Try it risk-free for 14 days and see how I use options to not only boost my returns, but also limit risk and create income. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.